What's up, Gould Miners? Today we welcome Beth Bungay to the show. Beth is the founder of Cash Cow Investments, a multifamily syndication group with over 300 units and $40 million worth of assets under management. Beth's experience in the real estate game spans well over 2 decades, and in today's episode, we dive deep into what makes a successful syndicator and a successful syndication. We kick off the episode by discussing Beth's foundation as a hedge fund manager and slowly transitioning into single-family investing before becoming a full-time multifamily syndicator. And finally, we conclude the episode with Beth going over some of the projects that she's currently working on, including a transitional housing facility. I don't think I've ever had a guest who was involved in transitional housing projects, and so some of the insights that she was able to give were really valuable, really interesting. And so without further ado, let's welcome to the program, Beth Bungay.
The Gould Mine Podcast.
Beth, welcome to the Gould Mine.
Thank you for having me here today, Danny. I'm super excited to connect with you.
Yeah, same here. And you know, this has been a long time coming. You and I actually met on a mastermind group that we were like both a part of. And you have a pretty interesting story. You were originally a hedge fund manager, right? Or previously a hedge fund manager, and then made your way into real estate syndication. So would love to hear what sparked that journey, what the hedge fund journey was like. Are you still doing that? Like what, and how did you make the transition, and why did you make the transition into real estate syndications?
Yeah. So, super exciting. I had started out in real estate back in Ohio in 1997. Made my way out to beautiful California. Actually got into appraising. So I have a lot of background on the real estate side. Meanwhile, continue to acquire properties and hang on to them. And I pretty much played Monopoly most of my life where I'm buying and holding, right? Which has done a lot of really great things. Kind of midpoint in that journey, I decided I wanted to open and run a hedge fund. So I did do that. And I really loved and enjoyed all aspects of it. I enjoyed the investors. It was really a dynamic thing. Then I met the man. Here comes the love story. For me, I realized that if I really wanted to have a relationship work, to do a hedge fund successfully meant up at 4:30 in the morning. So I really sat down and I said, look, my real estate's already, that snowball is already started. Once you start it with real estate and you hang on to it, it's a great snowball. So I did have to make that decision between continuing the hedge fund or sticking with real estate. And for me, what I realized is that love won out, but then I got introduced to syndications. And I was like, wow, this is dynamic because I love real estate. It's continued to be a huge part of my life, my kids' lives. It's done amazing things for our family, but I loved helping investors. So now what does syndication allow me to do? It allows me to translate that investor side and help them still build wealth in an area that I'm very well versed on and have been very successful in. So hence why I moved into the syndication and real estate space. Because I do love helping other people create wealth done in a very ethically and moral compass way.
That's amazing. So now walk me back here because I think you glossed over some important things. So you originally bought and held your own single family properties before you got into real estate syndications, before you got into any of the, you know, the fund work or anything. What you started with buying single family homes and holding them. Now, my question to you is the leap to syndications. Was this hey, I have more time on my hands. I want to raise money and do bigger deals. Or was it, I have bigger deals. I don't have the money, obviously, because they're way bigger. I need the money to do them. Because it kind of sounds like you went into the you went down the syndication route, but like you already had a portfolio of single family homes. And so I'm just curious kind of like what cued that transition for you? Like what made you step outside of that? Because a lot of people get comfortable in that zone, you know?
Yeah, exactly. So for me, I honestly don't need the money. Like I've done very well for myself. If I decide tomorrow to not work, I can stop. So can Warren Buffett, right? But some of us are driven by things that get us excited and motivate us. So yeah, part of it was selfish. At some point when you own real estate, you realize that your appreciation and your capacity to not have to pay taxes, it's timed out. So part of it was hey, I know I'm going to need to size up in my personal portfolio. So why not learn as much as I can? Because remember, most of my portfolio was bought and purchased right before the grand downturn back in 2007, 2009. I did not lose a single property. Not a tenant was evicted, nor did I miss a single payment. But that didn't mean that I wasn't going to a food bank. It also didn't mean that I was having to subsidize the mortgages versus the rent, because it is the California market, right? So syndications did two things. Number one, it was like, okay, this is a great way to learn and be able to 1031, because I do think to just go into something and without getting education can be very dangerous. So it made sense to get educated. But then it allowed me to do the second thing, which is really help people create wealth. So I just was motivated. My first goals were to take my first 100 investors to their first $1 million via investing. And that still stands a precedence for me. So rather my investors are bringing in $5,000 on our crowdfunding portal for a property we're doing in Vegas, or they're bringing in $500,000, $1 million. I always have a vested interest and give all of them 110% so that they really understand what they're getting involved with. Some people are familiar, some people are just learning, but I love being that bridge and that teacher.
Did you ever, before you started participating in syndications as a sponsor, did you kind of bridge that gap and like start as an LP in any deals, or did you like immediately just start syndicating your own deals?
So, because very quickly due to my net worth, I was kind of, sometimes in life you get to skip a couple of stairs, but that's because you already climbed those stairs. So sure. I was actually pretty quickly able to be offered projects. I turned quite a few down because when I looked at the underwriting, remember, because I had a hedge fund, I understand numbers. Because I have an appraiser license and background, I understand numbers. Because I own real estate, managed real estate, I understand the numbers. So there were quite a few deals that I walked away from. With that said, my LP positions are on the side where I'm also a general partner in those projects.
Gotcha. Okay. And you know what? Because we talked a little bit offline, and I remember you telling me, correct me if I'm wrong, but I remember you saying something along the lines of you were offered like KP in those first couple of deals. So you were signing for, and for those back at home that maybe don't know what KP means. So KP is key principal. So that's generally the person that's signing for the debt, right? They're guaranteeing the loan. That's kind of how that was your gateway into these initial syndications. Is that correct,
Yeah,
Beth?
That's definitely a lever that became available to me. So as when you're dealing with these large properties, you have to understand that the partners who are signing on the loan have to have a net worth at or greater than the value of that property. So in a way that lets you know as an investor, hey, you're dealing with people who have figured out how to manage their own personal budgets, right? And that's a key factor, right?
Yep.
I always say, I'm never going to take my wealth advice from somebody who hasn't built wealth. Okay, so I do, and I also say in life, it's a stair step theory, right? You should spend a third of your life helping people come up the stairs. You should spend a third of your life on the stairs with your peers, people who are at your level, but you should also spend a third of your life looking at who's above you and aiming up. And I've been very fortunate in my personal life that I've always kind of had those people around me, not necessarily my mom and dad, because I didn't come from money by any stretch of the imagination. I even had my own cheerleading uniform. Okay, so I've been working since I was very young. But I've had a lot of people that were around me and willing to give me information, willing to give me insights. So that's really where I kind of feel like now maybe I'm in the middle of that stair step and I need to also allow other people to come up there with me. Oh, goodness gracious, Danny. I hope that thumbnail of where we started with my curler in my hair when we started doesn't become the thumbnail for this presentation.
No, I don't think so. Definitely not.
And then now explained why.
I'm taking so many well, I'm just taking a lot of notes right now, Beth, because it's I like that. And I've heard that before, right? I've heard the third rule, but it's good to kind of like just keep that in the back of your mind. Because I think a lot of us, and I think especially like high performers, high achievers spend an inordinate amount of time looking up because they're like fixated on like, how am I going to get to that next level? And sometimes I feel like we either kind of like miss a lot of the middle, right? Where we're missing maybe some of that, like that interaction with our, current peers, or we do the thing where like, we don't pay it forward, right? And help the people kind of come up. So I really appreciate that sentiment, and I really appreciate that thought. And, coming back to, the syndications that you're a part of right now and the real estate deals that you're currently a part of, is there an asset class? I believe you're multifamily specific, correct? Or are there other asset classes that you're dabbling in right now?
Well, I look at different ones, but honestly, right now, predominantly multifamily. We're bringing other investors in, right? Predominantly multifamily. Do I look at other asset classes? Absolutely. If the moolah works, because it's cash cow investment, if the moolah works, exactly. Show me the moolah. If it works, then obviously we're going to do that asset class, because at the end of the day, a syndication is based on creating success for your investors, creating a successful asset that operates for your investors. Now, with that said, every project I take on, I'm also looking to see how it benefits that project itself, how it benefits that community, how it benefits those residents or those tenants. Okay, I do believe you have to check all the boxes on win. Everybody's got to win along the way. Kind of knowing that our first choices are driven by our investors and giving them great returns.
So in the spirit of your company's name, Cash Cow Investments, right? So obviously when I think cash cow properties, I'm thinking lots of cash flow, right? So when I would assume, and maybe this is a wrong assumption, but I would assume that you are then primarily focused on multifamily properties that cash flow, as opposed to playing the speculation, the lovely appreciation game, which a lot of us love to play, right? The riverboat gambler strategy, I like to call it. So you are more on the side of like looking for cash flowing multifamily properties.
I think you need both. You need both.
Okay.
So, and I get that from, going through the downturns. Remember, I was working to supplement my renters' mortgages to keep them in their homes. And I know what it looks like when you don't have the cash. But I also understand how wealthy that equity can make you. But you got to put bread and food on the table before you get the big paycheck, right? But yeah, cash cow investments is indicative of creating cash flow. But yes, ultimately in the end, the biggest return is going to be a return of equity, and that's exciting. So a matter of fact, like our property in Las Vegas, we have done something super dynamic where we literally, out of the 233 unit portfolio, 9 of those units, because we were able to bring in transitional living housing into it, has increased the rent on those by 236%.
Oh, wow.
And what does that translate to? That translates to moolah for the investors, right?
Yeah. Well, and that's the beautiful thing about, larger scale assets, right? When you're doing, hundreds of doors, a couple $100,000 to the bottom line translates into typically millions of dollars in appreciation, right? If you're looking at a 5% cap rate, that's like a 20x, right, return on each, like 100,000, right? You're looking at a $2 million increase in value, which, a lot of people just, you don't get those kinds of numbers, right, at the smaller scale, right? Now, what's interesting is you're in San Diego.
Yeah.
Right, Beth?
Uh-huh.
So did you do a lot of your single family investing in that area?
Yeah. So 100% of my personal portfolio is in California.
Yeah. Yeah. Which honestly, I mean, no wonder you were able to sign for so much debt, because those properties have exploded, over the last 10 years, 15 years, right? So you've had these properties since, 07.
Well,
so we're talking almost 20 years.
Are 19 and 17, and most of them were acquired before I had my kid.
Right. Well, there you go. So I'm curious, right? Because when you make that transition from single family investing into syndications, what was that transition like for you? Did it ever feel like daunting, or were you like, nah, I've got this? Like, because you're a pretty confident lady. So I have a feeling like you're like, nah, I got this. I'm fine.
I got this. Remember, I have the advantage of also being a real estate appraiser, right? Licensed real estate. Very difficult license, by the way, to have in Gould in the state of California. So in my background, I started that in 2000. Okay. So I've inspected over 14,000 properties.
Oh,
okay.
Wow.
So I know what stuff looks like. I worked for Beth a while before I started in appraising. Sure. So I understand power tools. I've, done hard turns on my own personal properties. My average tenant's been with me 7 years. My average turn time on my own personal portfolio is less than 10 business days. So all syndications is taking a bigger, broader spectrum and then figuring out how to help the other parts of your team reach the goals quicker, right? Or helping your team where they need help, right? So some people are going to be on the asset management side. Some people are going to help raise capital because they have the relations. Some people are going to be working on what's called the underwriting, looking at all the numbers. But I do believe as a steward of your investors' money, you should understand all of that on certain levels. So I get super fortunate because I'm great with numbers. I can look at projects with people and help them determine, hey, this is what this property is realistically worth. So let's send out an offer to the seller at this price point because it makes sense, right? And then when I say it makes sense because on the back end, the returns are properly calculated for the investor. The amount of reserves are at the proper level that they need to be at. A lot of people are starting out, they try and run this as thin as possible to get better returns. But the problem with that is when you're my investor, there's two things you don't want from me. Number one, you don't want me asking you for more money. Okay? So I need to figure out that business plan over here with buffers in it, right? And number two, you don't want to not get a check in the mail from me. So as long as my starting point allows that to occur throughout the hold, it's great. So I'm very good at helping people, especially when they're starting out and they just don't get it. And, maybe they run their household paycheck to paycheck. Okay. But I mean, just a point in case, I looked at a $24 million project yesterday with the team for the kind of set aside for deferred maintenance. They had scheduled about $180,000 on a 1972 vintage. Now I have no problem. Everything in this world is fixable. But remember, when I get to 70, I might need a facelift. Okay. And so do the property. Everything has to be done appropriately. So I said, I think that's a little bit light. And I call it a WTF fund, what the can happen will fund. And I said, we haven't been out to the asset, but even without going out there, you need to have more like 10% set aside without even knowing what we may or may not need to do. Just looking at it to get that first, LOI out. So that's $2.4 million. Very big difference from $180,000, don't you think?
Huge. How many units was this again? How many doors?
Well, it was like 200, and I believe it was 204 or 223. I did 3 of them yesterday, so I might be intertwining.
They had 180 in CapEx. That was it?
Yeah.
Oh, goodness. Yeah, someone doesn't know what they're doing. That's very interesting, right? Like, and how does one discern, right? So say that you're a first-time LP, you're looking to invest into one of these syndications or a fund. What are the things, because everyone has their own recipe, their own rules, right? But what are the things that you would advise an LP to look for when vetting not just the deal, but the sponsor?
What's their background, right? You're looking at that. I want to see experience. I'm okay. Some of the team can be new. Most teams do have some new people, but I also want to see some experience threaded into that team. I want to know that they're not being aggressive on an exit cap rate. And so for those of the newbies out there listening, cap rates, believe it or not, okay, a lower cap rate versus a higher cap rate is way more aggressive. So if that project starts out at 6.5% cap rate, I don't want them giving me my returns based on a 5% cap rate, unless they can justify where the data's come from. So I'd much rather see them entering at 6.5, exiting at 6.5, or entering at 6.5, adjusting up 1/10 of a point per year. That makes it more conservative. Or give me what's called a co-star that tells me what that market's projected cap rate's going to be in 5 years. And that is driven, right? I want to see where it's coming from, not just a wag on an underwriting or whatever. So I walked away from deals where I saw them doing what I call compressing the cap rate. They enter here and then they're saying they're going to get out here. Well, that's great. But right now, the cap rates have not gone in that direction.
Yeah. It's called wishful thinking, right?
Why? Yeah, that's called a hope and a prayer. And I can't write hopes and prayers to banks, and neither can our investors. So it's really important.
Yeah. No, that's all. So either keep it at the same exit cap, so entry and exit cap, kind of keep it towards the same, or even adjust moderately, right? Adjust up just a little bit. Now, what about, and just a hypothetical here, right? What about in the case of like a value add, Beth, where, there's significant money being invested into the CapEx or, in the hotel space, for example, because, I play in the hotel space, like sometimes we have the ability to reflag the hotel, right? And so in reflagging it, we're adding a better brand, or we're bringing in a better brand. And through that, we're actually increasing the value and decreasing, decreasing the projected cap rate. So, what about in those instances?
That's such a great example, Danny. And that's where that third box of a co-star that's looking at typical type assets within that market would be able to support the data. And that would be an acceptable, hey, this is hotels, yes, but this is multifamily, which is what it's being created into. And this is the projections in what's called co-star. Mm-hmm. And then at that point, like I said, just something that verifies it. Like, where is it coming from? Yeah, no,
I agree 100%. I agree. There has to be something justifying it, right? It can't just be like, well, we speculate that the rate, the cap rate's going to be like 4 and we came in at like a 7. I'm like, how? And this makes no sense.
And the are probably in our lifetime, they're probably going to go up and down a couple of times.
Sure.
But sometimes that cycle is going to last 10 years. And if you're sharing a 5-year hold with me, the timing of it being at the lower cap rate, is 1/10 of a percent, 1/10 of a 10-year period. So I want to see conservative. Show me an apple, compare it to an apple. And like you said, you're dealing with conversion. So you have an apple and an orange. So then you need to show me why these are different. So a third party source such as CoStar can absolutely provide the support that's needed in a project.
100%. Now, another, just kind of slightly shifting gears right now. You talk a lot about, or you've discussed before this idea of, skin in the game, right? Sponsors having skin in the game, investing money into the deals. Why is this so important, right? And what would you say is a fair kind of like percentage of equity being contributed by the GP versus equity being contributed by the limited partners in the deal?
So it's going to depend on each and every syndication. So typically the bank will require the general partners, which are the owners and operators of the deal. The bank is going to require them to have between 5 to 10% of skin in the game. Mm-hmm. Okay. So that's actually a banking requirement. So, but the question is, who has the skin in the game on the team? Right? Because that team might be comprised of, anywhere from 5 to 10 different people, depending upon the size of the project.
Sure.
The bigger the project, the more moving parts, maybe the more people out of the team. The smaller it is, less people.
But
I do think it's important that the people who are in the project have skin in the game. And that includes everybody I bring on a team. The only person who gets a free pass on skin in the game is if you're the person who brought me the project. If you brought me the project and you just have no money, you get a free pass. It doesn't mean you get ownership of that general partner. Whoever's putting that money in, they're all going to get a part of that, hard money that's going in. The most at risk money is the money that it takes to get these projects off the ground. And investors are not allowed to have exposure to that kind of risk, which is great. They shouldn't. Their money only starts into play once the project's closed and operating. Okay. So like for me, when I put together a team and I'm like, hey, we've got a purchase sales agreement, we're moving forward. We need someone to raise capital. We need somebody on asset management. We need earnest money. So there's all these little, parts that make a syndication work. And if I'm bringing people on who did not bring the actual deal to me, every single one of them is going to have anywhere from $10,000 to $30,000 of their own money to get it off the tarmac. And the reason I do that is because I want to see not only that they have, it's easy to say I will, and I am. It's another thing to write a check, right? And I think if you can't come up with $10,000 to $30,000, that might be a wake-up call, right? Okay. And maybe you're starting out and you're just learning. So it's not, but I'm pretty sure if you've got good credit, most of us could get, $10K off a credit card. I certainly know I could before I even had any net worth, right?
Sure.
Buying a house that was brought to my attention, how valuable it was. And I think that's when I fell in love with real estate. I was like, oh my God, really? I'm like, I'm in debt. I can't buy a house. Yes, you should, because you're going to get tax write-offs. You're going to get to write off the interest. And I was like, holy Batman. So really, that was kind of my spark that lit the firecracker.
That's awesome. Yeah, no, that's awesome. So, yeah, and by the way, just to clarify here, when you say 5 to 10% of the bank is going to require at least 5 to 10%. That's 5 to 10% of the equity contribution, not 5 to 10% of the total project, right? So, so just to clarify there for people, because people get very confused sometimes,
that's valid. Thank you, Danny. I appreciate you clarifying that, because that would be a little overwhelming, right? So to keep the numbers simple, let's say you're raising your project's $1 million project. You need to have $200,000, which would represent a 20% down on it. Then you need about 5 to 10% of that.
Of the 200,000. Right.
So 10% being about $20,000. And those are just smaller numbers so that we can digest that.
What markets are you mentioned Vegas is one of them, which love that. We should connect afterwards on that, because that's a market that I'm very interested in. But I'm just curious, like outside of Vegas, what other markets are you bullish on right now, and why?
So I'm in the Texas market, and I'm still very bullish on the Texas market. I'm bullish on the Florida market. If you can make the numbers work now, they will work better when insurance retracts. And so, listen to what I'm saying. If you can make the numbers work when it's a tough market, because as we all know, insurance numbers are a little elevated in 2024, 2025. And so if the numbers can work on that now, and then there's a retraction, you get to benefit from that. We also have a little bit higher interest rates than we had seen the couple of years prior. So I always say if it works when it's a little bit more challenging, it becomes even more profitable as some of those challenges start to dissipate. Because remember, what goes up does come down. So I like any markets where the moolah works. I personally don't mind California because I live here.
Sure.
But most people are not going to be super California friendly in a syndication unless they're from California. So you really have to know who your audience is. Las Vegas, I love our project there. We're still raising. We only have about $1 million, I think, left on a over $16 million raise. We are closed, operational, and actually giving out the returns to the investor that were projected at year 2 in our business plan. So we are kicking butt, making names. We even have a little twist. Probably many of you haven't heard of it. It's called crowdfunding, which allows even a little investor with $5,000 get involved up to an investor who's accredited with that higher net worth. So it's a super exciting project because it does allow so many people in this industry to have an opportunity to be an investor in a project, whereas you and I both know usually starting points are between 50 and 100K, depending upon the project. 1,000.
Right. Yeah. So, okay. So the minimums are a lot lower then, which is, I mean, that's nice. You know, if and you were able to raise almost 16 million doing it that way, Beth?
Well, so we have the accredited side, which the minimum's 50,000. Okay. But we have the non-accredited. And the reason for that is because one of the key principles on it, he is really big into education in this multifamily world for people who are in it. One of the things I loved about it is that I love educating people. So it gives a lot of people a chance to come on a project and see how they operate without having to spend a ton of money to get into one project. They can see it. We've done an investor day back in November. About 10 days ago, we did a bus tour of the project for community in RE Mentor Insiders Club of the entire asset because there's so many moving parts, right? We have transitional living. We're utilizing grant money that's government funded, been approved for the next 10 years, already in the kitty in Las Vegas. Returns are crazy amazing. And the crowdfunding actually makes us SEC regulated, which is very unusual for a syndicated product.
Yeah. Wow. That's interesting. I've heard of people crowdfunding for these deals before, but I've never actually spoken to one before. And I know that one of the challenges with that is all of the legal hoopla that you have to go through to do the thing. So it sounds like it's very real from what you're. Yeah. Okay.
We were in the top 10 largest crowdfunding last year.
Really? In the entire country?
Yeah.
Oh, wow.
Yeah.
Wow. That's amazing. Well, that sounds like a really fun project. And you said transitional housing. What exactly is that? Like, I'd love to hear just a little bit more about this project because it sounds interesting.
Yeah, absolutely. And you guys can contact me. I've got Zoom links connected in my website. If anybody wants more information, they can absolutely tap on that. But so our transitional living is building in different programs in the Las Vegas area because they created a program that's Clark County funded, which is Vegas's county funding to reduce homelessness. So one of the parts of the programs that we tapped into is actually to give people a hand up, not a handout. And that's for them to get out of jail and be provided housing. So for many of you, you might not know this. If someone goes to jail, they cannot come out of jail, even if they had perfect behavior, they're getting released early because they've done well. They cannot come out of jail unless they have a permanent address. Otherwise, they have to stay there and wait till they time out of their sentence.
Interesting.
And unfortunately, a lot of landlords are not willing to help people like this. But there are a lot of good people that just make a mistake. And imagine in Las Vegas, there's probably you made a mistake. And mom and dad probably don't live in Las Vegas because what happened in Vegas, clearly now they found out happened in Vegas, right? So, and we're super blessed because one of the ladies on our team, who's the dynamo who created the entire project, she had actually worked for Hope for Prisoners. And they have a really high success rate, providing them skills, getting them job training. But what the part that they were missing that she was always frustrated by was the housing part. You know, so people would get out, they get on their feet, but landlords don't want to rent to them. And rightfully so. Okay. But everybody deserves a second chance, especially if they've done their time and they've had good behavior. So no, we don't rent to sex criminals. There's a few things that we will not bring in. We won't do, murderers, et cetera, et cetera. Like ours are kind of that simple level. You might have got a DUI and it's your second or third offense. So you got thrown in jail. Okay. Yeah. So we're really trying to be cognizant of the type of people that we're trying to help. But people deserve an opportunity, especially when they righted their own personal ships, right? So we're
sure.
excited. And Nicole is, she has two cute little girls, right? And she's a blonde. So I'm painting the picture here. She goes, Beth, I got out of my big truck. And this guy's like, Nicole. And she's like, And he goes, no, Nicole. And she's like, yes, do you know me? And he goes, you're famous in these parts. So they all know Nicole is literally making a difference, making a difference in Las Vegas, making a difference for individuals, and it's making a difference for the investors.
That's really cool. So then that housing, is it government subsidized, or are these people just paying? Okay, so it's government subsidized and they're on parts of it. Okay, understood.
Once they pass through what the government will pay, as long as they've done what they're supposed to do, we will continue to allow them to move into other parts of the portfolio. Because it's 233 units scattered in a couple different spots in Las Vegas. So if they make it through the transitional living, they do what they're supposed to do. They have a job. We will rent to them in one of our other properties once they time out of, the government assistance in that category. So, and we also master lease the 9 unit, which means basically like they give us 100% of the rent. They pay 100% of the utilities. They do 100% of the maintenance. And we get 100% of the rent and only have taxes and insurance on that 9 unit. And same thing with a 20 unit building. So we are doing things to maximize returns for investors, but we're also doing things to make impact for Nevada as a whole and also for the people who are renting from us. That's
awesome. That's really, really interesting. I don't know that I've ever had anyone on that is involved in those kinds of projects, or at least not that we discuss. So that's, you learn something new every day, right, Beth? So, hey.
Funny fact, Danny, real quick. So when I got involved in syndications, my dad goes, so you're going to make money off the tenants? Like, it was incredible. So when I did come on this project, it took him about 90 days of being like, Beth, look at it. Like, it's too many categories. It's confusing. But when I sat down, financially, it was so good for the investors that I said, okay. And I hopped on a plane and flew out there because I always go look at assets that I'm bringing in. Yeah. And then when I got there, I'm still looking for reasons to say no, if I'm being honest, Danny, at this point. So they're digging up the plumbing. They'd already closed on the entire asset. And I'm like, oh, so did you know this existed? And they're like, yeah, as part of our underwriting, we had the money set aside. Okay, well, how much was it going to cost a door? XYZ. Okay, and how much is it costing? Under budget. Okay, these are good checks when I'm looking at the project, right? That means they underwrote it correctly because I came on after they actually closed. I came on the team last August. So after they had actually closed. And so I'm checking to make sure they did the due diligence right, because I have to accept everything they've done. So they did all that right. Okay, I'm in because it's good for the investor. They get back their investment at year 5, but they still get full exposure to some cash flow and to the equity on the back end. And that's honestly how wealthy people get wealthy, because they have returns over longer periods of time. I know people are excited about a 2-year term, but I'm more excited about a 10-year term where I'm making a 20% ARR over 10 years. That's moolah. So I do love this project. And then, this was the one project that I asked my brother who invests in my projects. I said, can you please make sure Dad's on the first webinar for this one? And then my dad, who does love to help out people, he was a minister when I was a kid. My mom was a businesswoman. He was actually on there. And so it gave him, even as a father, an opportunity to glow a little bit about what his daughter's doing. And so I feel blessed to be able to share that with him.
That's awesome, Beth. Yeah, no, that's it sounds like a really cool project. And, for those who are interested in that project or just learning more about cash cow investments and how you can partner with Beth in general, all those details will be in the show notes. And Beth, we've made it to the end of our time here, but before I let you go, in traditional gold mine fashion, I'm going to have you leave the audience with one final gold nugget. Take it away. Okay, awesome. And it has nothing to do with cows. That's funny, huh? Okay. I just want to kind of leave you with the nugget for anything you're doing in life.
I think so many times we get impatient because we want to be at the finish line already. But I want you to think of the Great Pyramids. So the Great Pyramids look like this. It's a triangle. One of the strongest shapes is a triangle. It's unbreakable, right? But I want you to think about what part of that pyramid took the longest to create. Because the vision happened way before the pyramid got completed. But the part that takes the longest to build is the base.
Right.
And you've got to build your base right. And it's a lot of work moving one stone at a time. But eventually that persistence over time creates something magnificent. And I hope that all of you will have grace for yourselves in whatever you decide to create in your life. Thank you.
Awesome. That's awesome, Beth. No, I really appreciate that. And some really sound advice there for anyone that is maybe just getting into it and you're rushing into things, right? You don't have to rush. Just make it what it is and keep on trucking away. Beth, you have been awesome. This has been a great episode. And I hope this isn't the last time we get to chat on this podcast. You've been a great guest and I look forward to seeing you succeed and seeing all your successes here in the coming months and years.
Beautiful. Thank you so much again, Danny. Thank you to your community. And I look forward to staying connected with you through the upcoming years as well. Thank you.
Awesome.